And we're live. G'day. This is Zenium Live, where we talk all things money, finance, and property. And I'm your host, Scotty North. And we have had a bit of a hiatus. We've had some equipment changes. Even though you can't see anything from your side of the screen, it's completely different on the other side of the screen. And you'll just have to take my word for it, which is why I'm back wearing headphones, because we had some fun audio issues to begin with today. So I thought we'd kick back on our shows for the remainder of the year, and we'll start with some familiar faces, namely, yours truly. And I know that you guys out there have missed that greatly. So I've been getting emails and love letters and things, and I just thought I have to get back on the screen in front of you, and at the same time bring on one of the regulars to the show, and of course with a much better looking face, PJ Patterson. How you doing, mate?
Scotty, I am very well indeed. I tell you what, this lockdown stuff, I've gone back to headphones because if I took them off, I would look like some guy from a 70s TV show, because I haven't had a haircut in about 6.5, 7 weeks. So it's, the first world problems we have, isn't it, right? I can't get a haircut at the moment. So anyway, it's good to be back and back in the swing. I'm sure, we'll talk, I'm sure, as you said, all things money, property, finance, economics, whatever today. So looking forward to having this chat for the next 25 minutes or so.
Yeah, all right. Now that sounds fantastic. All right. So look, firstly, a big shout out to, I've been looking at our results online in the podcast, and people have been listening to that, or the backstory and the other episodes there. So don't forget, you can check them out. And if you're listening to us now on that, then thank you for tuning in on the podcast. You can get that from all your podcast apps and what have you. And of course, anywhere you see us broadcasting now or on repeat, Facebook, YouTube, LinkedIn, etc., you can watch, join in, comment. We'll bring out comments on the screen. And that's if we're live. If we're not live, then I'll be sleeping and you're watching it. You can do that then. But don't bother commenting and expect an answer, because I will be sleeping, right? So that's just how it works. All right, PJ, it's been a few months since we have had a discussion. So, mate, what's happening in the markets? What's the winners? What's the losers? Where are things at?
Great question. So let's talk about where we've just come from. So I think it's probably been about 3 months since we had an update.
Yeah, that's right.
Had a show. Yeah. Okay. So in the last 3 months, we've seen unprecedented reopening of the world economy. Of course, we've seen a lot of the Australian economy reopen. We've seen the U.S. economies reopening, Europe, etc. And if you remember the language that I use when I talk about investing, I talk about the 4-quadrant model, which is a model that Keith McCullough and the guys at Hedgeye put together, but it's a 4-quadrant model. And if you may recall from the last show, we were in deep quad 2, which was one of the best quads to be in, because that's when the stock market is ripping, economies are growing, inflation is reasonably benign, and interest rate policy is also pretty neutral to accommodative. And we've had a stellar run of 9 months or so. Certainly the super balances and the investment account balances up until June 30 of this year for all of our listeners, hopefully, and viewers, and certainly my clients, did exceptionally well. And that's what happens in a quad 2 environment. And so what's happened since then? Well, we've had this bloody thing called the Delta variant. I'm not talking about Delta Goodrum. I'm talking about COVID Delta variant. And it's reared its ugly head and has once again begun to wreak havoc around the world. So here we are now in Australia in lockdown. Doesn't seem to be abating anytime soon. There's snap lockdowns going on in many of the states. New Zealand, God love our New Zealand Kiwi brothers and sisters over there, with 1 case, have shut down the whole country again. And I don't know what that's going to do impactfully, or what impact it's going to have on the Australian economy. I suspect it's not going to be positive. But we have pivoted to what is known as Quad 3. And let me just quickly explain what that is. So Quad 3 is a stagflationary quad. And for those of you who don't know what that word means, it probably means you were born after 1985. But stagflation is not a good economic situation to be in. It means we have slowing or low growth, and we have inflation. And that is a very bad environment to be in, because it means the cost of everything is going up, but we're not seeing wage growth and economic growth and such like. So we are actually in that environment right now where we're seeing a lot of inflation. You'd be seeing that at the pump, probably at the grocery store when you fill up the basket. Possibly other things in your life are going up as well. Cost of living is increasing. And so hopefully we'll get out of this environment in the next couple of quarters. But for the time being, that is where we have come from and where we are right now. So maybe we can just start with that.
Yeah, okay. That's a pretty good point. So before we delve into, I mean, we've talked a lot about inflation on the shows, right? I mean, if you want to go and check out, there's plenty of back shows about inflation and how it works and what the effect is and what have you. And I think you've covered the quads specifically in a show, but we probably definitely want to make sure you always touch on that. I guess I wanted to question on one of the points that you just made is that, we don't know what's going on with the Delta. Are we going to get an Echo or a Foxtrot variant, or who knows what's coming next, right? Because there's a lot more letters left in the alphabet yet to go. Mm-hmm. My question is, at what point does this become the normal thing, right? Because people can only go on hold for a certain time. And so now we know that there's, someone sneezes and we lock down, or we know that there's this, or we know that there's that, or we know that there's X number of vaccination percentages and there's this sort of stuff. So when does the abnormal become normal?
Wow. Well, as you can see behind me, there is a teacup. And if I had to look into that teacup and read those tea leaves, the answer is I had no idea what is normal anymore. I kind of lost track of that. I would certainly hope that some reason will eventually prevail amongst the authorities, in that there will have to be a realization that we cannot just keep locking down economies, as you said, because people, catch a cold. The reality is, and I don't want to wade into the politicalization of the vaccines and all this stuff. I know both of you and I have a fairly strong opinion on these things. But the reality is that we have to be able to live our lives as normally as possible. And what the government's trying to do, they think anyway, of course, is get on top of this and stop the spread of it. But look, let's face it, it's going to spread probably as quickly as a bushfire in Australia spreads on a very hot summer day when the tinder is dry. And this thing is very contagious. The flip side to that is, how many deaths does it actually cause? And, it doesn't really cause a lot of deaths. So I think at some point, the people are going to say to the premiers, to the, God, I can't even think of him, the prime minister. Geez, that tells you how often I don't watch TV. But, they're going to have to say to these guys, look, we're just going to have to move on. So let's deal with it. It's not causing, people to drop dead just walking down the sidewalk. We've got to move on with this thing. We've got to open the economies up so that people can live their lives without being reliant on the government, support payments and all this kind of stuff, and conduct business and do all of those things. So is that going to take another month or 2 or 3? I don't know.
Well, I don't know. But I mean, are you seeing it from clients? I mean, I know some of our clients are definitely, last year it was very much like holding on, don't know what's going on, whatever. There is definitely the attitude of, well, what's happening this weekend? Will we be able to go to the beach or will we not? But it's part of the life. Now I'm sort of starting to see that people are going, well, we might not exactly be able to plan a date on something in the future, but we still need to start planning for the future. And when I start hearing people talk about that, then I'm not going to say there's hope for the future. I mean, there's always hope for the future. I'm not saying that it's really hopeful and happy. What I'm saying is that there's an acceptance of a way of life, and the acceptance to then move forward with that way of life in mind.
Yeah. Look, I have no idea what it's gonna look like or what it's gonna take. I mean, that's a question I'm afraid beyond my predictive powers. I have no crystal ball.
Come on, PJ, you're letting me down here. You're letting me down. I mean, you've got predictive powers and all sorts. So from a market perspective, let's talk about how markets price in the future. And that's kind of what I was trying to get at, not so much on a personal, but are we seeing fluctuations in markets because of lockdowns, or is that sort of now the accepted normal path forward?
Sure,
and it's like, this is where things are going.
Yeah, I think the markets in large part have accepted this in their discounting mechanism. And until we start to see this, really, the trigger for this will be to see how it impacts company earnings. So one of the key metrics that you look at to determine whether the economy is growing, shrinking, whatever, are the earnings reports from companies. So at the moment, earnings are expanding or continue to expand because we've come out of a lockdown in an extreme situation during the 2020 period where, let's face it, the world economy was shut down. And we've moved into this, let's call it a reopening phase. Now, it looks like the reopening phase is going to be filled with periods of shutdown again. So I guess, the best way I can put it in market parlance is we're going to have volatility around the COVID new strains and the lockdowns, and there's just going to be volatility and uncertainty around that, I guess, until governments and authorities, whoever, find their feet and what they think is going to be normal behavior and normal safety, whatever, going forward. Market doesn't seem to be too worried about it at this point, I must say.
Okay, because that's kind of what I was getting at. So what's the market going to? So that's really interesting. All right, we're just going to pause here, PJ, because we're getting some comments. What do we got here? We got Michael's call past and said he's so happy right now. That must be because I'm back on the screen. Maybe it's you, PJ. I don't know, but he's happy because one of us is back on there. We've got serial commentator Steve Skinny. People are adaptable, but only to a point. Yeah, I'd agree with that, right? And that's the part that you were talking about, PJ, in that, like, you don't know. I mean, we're seeing people do certain things, but we're not, and we don't know what people are doing. And at what point are they not adaptable, and how will the markets react to that? That's a good question. We have Michael Paris joining us. G'day, Michael. How you going? Scotty and PJ, do you think we'll see negative interest rates in the short to medium term? Well, Michael, that's a way to comment and hijack the show for the next 20 minutes. So thanks for that, because that's a bit of a topic that PJ and I actually like talking about. So I'll let you come back to that one in your own time there, PJ. And we got Michael saying he's missing us and all sorts of another Michael Carr's back on. Thanks, Michael Carr. That's really special. All right, so PJ, what do you think? Where to from here? Besides the negative interest rates, which I was actually going to have a quick word on today, what's next? What's next for the market, right?
Yeah. Well, okay. So, I mean, look, I can weave the negative interest rate thing into this answer. The market is telling us right now, and this is because of the inflationary pressures that have built up in the market. So we've got the US dollar, which today and yesterday has had a bit of a pop, but is in a bear market. And because the US dollar doesn't do well in any other quad but quad 4, and as I've already established, we're not in that quad at this stage, it just means that we're going to continue to see inflationary pressures build and flow out of the US and into other countries. And so that means that the chance of negative interest rates is, I know you never want to say anything is zero, but it's pretty low, because the central banks are going to have to begin to deal with the inflationary situation. Now, the US Fed has already sort of reluctantly now begun to acknowledge that inflation exists, even though we've had it for the last year flowing through the commodities markets in particular. And all you have to do is look at the price of oil and see that it's gone from around 30 some odd dollars a barrel during the peak of the COVID crisis to today around 66. This is US dollars, of course, a barrel. So we've had, something like, what is that, 150, 180% increase or something in the price of oil. So the likelihood of negative interest rates is pretty low. And in fact, I actually think we may begin to see the bond market adjust itself with higher interest rates, because the bond market will sell off, of course, to adjust for the inflation that's coming through. And we'll see interest rates rising. So there you go.
So do you reckon that on this interest rate topic, what do you reckon the real inflation rate is? I mean, the central banks always say between 2% and 3%, et cetera, et cetera. But is there a real number that's another number that we could actually access?
There is a real number that's another number. And of course, the inflation figures that are released by the central banks tend to exclude two of the biggest things that impact that number, which are housing and energy, and sometimes some other things. But the inflation rate is probably, I think I checked this the other day, and the inflation rate year over year for the June quarter in Australia was 3.8%, which is outside the target range of the RBA's stated objective of 2 to 3% inflation. And they've even stated in prior meetings that they wanted to let inflation run a little bit hot. Now, I don't know, what that is. What's hot? Like, is that 5%? Is it 10%? Is it 12? I don't know. But the real inflation rate, gosh, who knows, is probably somewhere around 7 or 8% in Australia, and it could be as high as 12 to 15% in the US. So I think this is a very serious. Yeah, this is a very serious situation and predicament for people who are in the middle class and certainly whose wages are quite low, they're going to be feeling it the most.
So just to touch on those house prices and interest rates, etc., if you're talking about a 3.8% was the rate that you saw, but if we're saying anywhere between 4 and 8% was the actual inflation rate in Australia right now, most home loans are less than that, right? So in terms of a real tangible outcome, are we actually at a negative interest rate compared to when we look at the inflationary rate? Like what can we do to look at that? Because that would be a big reason why, if our inflation rate is actually really more like 5, 6, 7, whatever percent, that we're not going to see on paper those little negative signs coming up in front of your debt rate, because we're actually there now. If we can get a home loan for 2% or 2.5%, and our inflation is 5%.
Yeah, of course. I mean, on that metric alone, the way you just described it, you're absolutely right. We are sort of already in a negative interest rate environment because of the inflation rate. So, you could make that argument that that we are in a negative interest rate environment, even though you don't see that, priced into or flashing up on a screen saying, the Aussie 10-year is negative 30 basis points or something like that. So that's a good point that you make there for sure.
Yeah. All right. Okay. So, moving on from the inflationary topic. So the market's performance coming into now, we're coming into the crazy time, September and Christmas for the rest of the year. What are things being priced in, and where are we looking?
Well, again, we're in quad 3, and so that's just going to mean more commodity price inflation. It's likely that the energy complex will continue to rise with the geopolitical stuff going on now. Afghanistan has fallen back into the hands of the Taliban, and so who knows what that's going to do to destabilize that region, if it'll have any flow-on effects in any way to the Middle East. So there's a number of things to watch, but I would certainly be focused on inflation at this point and watching to see what happens with continued inflation pressures. It's going to be sticky. There's a word that the Fed likes to use at the moment in the financial media in the U.S., which is that inflation is transitory, which suggests that we've just had a pop in inflation. It's going to immediately come back down. This is not going to be the case. Inflation numbers are going to continue to be elevated, and that's going to start to cause some serious problems in other parts of the economy. So again, we just have to wait and see, as we always do with the data that flows through. But for the time being, there's a couple of tailwinds, I suppose, that are pushing us along. The first of which is the fact that in the US anyway, and I dare say it's probably the same in Australia, because of all the lockdowns and all of the restrictions that have occurred in the last year, there's a lot of pent-up demand still floating around in the economy. So consumers haven't been able to do what they do best, which is spend money and go into debt, continue driving the economy through consumption, which is one of the largest components of all G20 countries' GDP figures. So there's still a very high savings rate, a lot of pent-up demand, and a lot of money that has to replace durable goods. Businesses are going to spend money on CapEx. So that's those are some of the tailwinds, I suppose, that we have at our back. Now, once that stuff gets exhausted, we have other things like the infrastructure projects. I think the U.S. Congress is considering a bill that's going to spend something like $1 trillion on infrastructure spending in the U.S. It's going to be one of the largest infrastructure spends probably in...
Wasn't it $1 trillion on infrastructure? It was a $3.5 trillion bill because you needed the other 2.5 to grease the palms on the way through?
Something like that, yeah. The pork that goes along with the rest of it. So, there's going to be unprecedented government spending still coming down, and of course, all the other things I've just articulated. So I think we've got, some tailwinds that are still blowing and should continue to drive us back towards growth and back towards a quad 1 or 2 scenario. So, we may not be in this stagflationary environment for too long because, of course, the government's going to want to continue to try to juice their GDP numbers and everything else. So who knows? I mean, I just take these things literally day by day, week by week, month by month, and make changes as and when the data changes. So I'm very data dependent when it comes to evaluating the outlook on markets. But for now, what I can confidently tell you is we're going to continue to see stagflation for at least till the end of this quarter.
Yep. All right. Okay, good. Now, we've got another question here from Michael Paris. This might change our topic again a little bit here. So Do we feel commercial property values may soften somewhat once interest rates start to rise by pushing cap rates a bit higher? So will the interest rate rise have an effect on commercial property values?
Well, this is your space, Scotty, the commercial property stuff. I mean, look, I don't know. It depends on where you're talking, right? So commercial property is a huge market. We're talking industrial, warehouse, office. What are we talking about here? Broadly speaking, I think that, increasing interest rates will affect all asset prices, including commercial property. But maybe there's a demand there for commercial property because people are decentralizing away from the cities, the CBDs and the such like. I spoke to someone today who works in the CBD. He doesn't go into his office maybe once a week to just check and make sure that it hasn't flooded, that the fridge is still running, that sort of thing. And the city's dead. This is Sydney, right? I'm in. So the city is completely dead. Now, long term, what does this mean? Are people going to be going out to suburban areas and buying small offices and warehouses and things and operating in a more decentralized model? If that happens, I would have to think that there'll be some demand for commercial properties in those areas. Hard to say for sure, but certainly interest rates will factor into, the pricing of all of these things.
Yeah, well, I guess the point is that as interest rates drop, that people sitting on cash are looking for a different return, and therefore they then gravitate towards other things like those, Bunnings complexes and stuff that are bought on ridiculous cap rates, usually by industry, institutional super funds and others. So, I think it will possibly have an effect, but I agree with PJ. It will definitely depend on the product and where and the tenant. I think that you're still going to get, those AAA rated tenants that are going to push that cap rate right down low, which will keep those valuations up. So, we'll see how it goes on there. All right. So what else we got here? We got a bit. So Daniel, g'day, Daniel. How you going? Good to see you at the beach there. Thanks for stopping by. Great question, Michael. He's talking to you, I think. And yeah, okay. So I agree, Michael. So Michael's saying here for those listening on the podcast that that silly price are being paid for industrial, and they've really compressed the cap rates. Won't go into how the cap rate would work here. We'll probably do another session on that there because it's actually quite interesting. And people are buying at auction as if they're buying a home to live in, which is buying on emotion. So we're crossing over to our property show now, which is in this stage of the market. People are buying emotionally, and we're seeing that everywhere, which is the next thing I want to talk to you about, PJ, and you touched on it with the cities, is that we're still seeing an exodus from cities and other bits and pieces. I'm on the Sunshine Coast, and we're seeing that happen all the time. People are coming up here, and as soon as Sydney opens up again, there's probably going to be a next floodgate. So last year we had a bunch of Melbourne people move up. This year we're probably going to have a bunch of Sydney people moving up to here and out of Sydney and into regional New South Wales, etc. And then the third wave is going to be when they hit vaccination targets and they open up the international borders. I mean, I know we're the laughing stock of the world now. Last year we weren't. We were the golden child. This year we're the laughing stock. But underlying doesn't matter. There hasn't been many cases in Australia, and people are going to want to get here. So I think we're on the track for, once those things happen, there's a great influx of people moving around the country. PJ, what do you reckon?
Yeah, I think that's a pretty good assessment of the situation. And certainly there is a demand in real estate terms that we don't currently have, which is the foreign buyer. And that's because they can't get here or they're not being let in or whatever. So, look, I think, your third wave theory there that we'll have a wave of foreign interest, especially if the Aussie dollar doesn't recover, of people coming in, buying stuff up. And look, let's face it, with all the stuff going on in China right now, too, they're cracking down in a number of areas because they're actually in Quad 3 as well, which is a terrible place for the Chinese economy. They would prefer to be in any quad but Quad 3. I think as soon as borders and things like that open up, we're going to get a lot of Chinese nationals coming, wanting to come back to Australia and buy real estate here and everything else. So who knows? Maybe we'll see, the China pop in another 6 to 12 months.
Well, and as you said, if the dollar doesn't recover, then it's still essentially cheap compared to the rest of the world, right? I mean, so there's those sort of things here. So while we're in, lockdown number, who knows what, in Melbourne, 8 or something, or 7, and Sydney's really just had one lockdown this year, but it's gone forever, right? So we're in that season. It's pretty hard for us to sit here and say, oh, it's going to be good and rosy at the end, but these things, they cannot last forever because it's physically impossible. And if food, water dries up, all that sort of crap, it's like being in a fortress and closing the door. It's never going to work, even though that's what we call, right? Fortress Australia. We know that across the world right now. But all that aside, you're reading the same tea leaves I'm reading, and there's big activity that can still come from within and from external.
Oh, most definitely. And don't forget that, we are a commodity country, right? Our economy is quite heavily skewed towards the commodity complex. So our exports, net exports and things like that will continue to rip, especially if the U.S. plans on spending $1 trillion or more on an infrastructure program. Once China gets out of Quad 3 and resumes its expansionary phase of its, thousands of years life cycle and continues to do the Belt and Road Initiative, there's still going to be a lot of demand for natural resources, including iron ore and copper and zinc and all of these things. So Australia, I'm not worried about Australia just becoming an irrelevant country and just rotting from the inside. We're still going to have all of those things going on. But as we've been talking about, at some point, the average person in Australia is going to need to have the opportunity to make a living, to feed their family, to have economic freedom, all of these sorts of things. And right now, we're not seeing that, particularly in places like New South Wales, where the whole joint is shut down. I mean, it takes me, 3 minutes to drive from my house to my office, which, on a good day, it takes me 7, right? So my travel time has just halved, which I don't mind. But it just goes to show you that no one's out doing anything. I've been to, the local shops a couple of times in the last few days, and very, very quiet. So I am fearful that the longer this goes on, the more frustration and anger and other things are going to build up amongst just the average punter in Australia. And eventually that's going to have some sort of consequence.
Yeah. And that's the part we don't know, right? That's what Steve said earlier on, that people are adaptable, but to a point. And that's the point where we don't know. So we just got to try and read those markets and prepare, I guess.
Yeah. Well, again, for now, everything is going as normally and as swimmingly as I guess we could expect. I think if this lockdown thing persists for another, say, 1 to 4 weeks, I think you're going to have a lot of really irritated people beginning to apply political pressure to the Premier and to other, politician stuff in Australia and in New South Wales in particular, to lift this and just kind of say, look, we're not going to be able to get to 0 cases. We're not going to be able to get to a vaccination rate of whatever you think we're going to get to. So let's just reopen and roll the dice and take our chances. That's going to be an interesting outcome when we eventually get there. The Premier, and again, don't want to get political about this stuff, but the Premier gets to continue collecting her salary while she's up there at 11 a.m. every day saying, get vaccinated 50 times to try to implant that whole thought in your head or whatever. But I've got clients who are working from home and might be on a third of their, not a third, 2/3 of their salary or something like that, and are hurting, and small businesses as well that are shut and can't get out there and operate. This is not economic freedom. It's not freedom as I think what we have become accustomed to in Australia for so many, many years. So anyway, it's going to be interesting.
All right. So before we wrap up for the day, we always end with one sort of tip. Now, I know you're not supposed to give, because you're licensed in what you do. You can't give one stock tip to watch, but maybe a sector to give an idea out. I'll give you a stock tip to watch: Pfizer. But anyway, I can do that because I'm not a financial planner. I'm a property dude, and there's no rules, right? But PJ, in the space, are we looking at healthcare? Are we looking at mining? Like, what are you watching for your clients?
Yeah, well, I've already alluded to it several times during this broadcast, and that is the energy complex. So energy and oil is one of the best places to play the reflation and inflation trade. So you can buy, there's an ETF put out there by Beta Shares, Fuel, F-E-U-L, which is, F-U-E-L, Fuel. Can't even remember how to spell fuel. That's how bad it is at the moment. And it's a great way to play the energy complex if that's what you want to do. But things like high quality names. So if you're going to be a stock market investor or managing your own money in any shape or form, self-managed super fund, what have you, you want to stick to the big, deep end of the pool right now, large cap quality There's another ETF, QLTY Quality, that owns a lot of those large cap companies. They will weather this storm beautifully. They have pricing power. They can pass on the cost to their customers, et cetera. So there's two ideas that you could investigate to continue to protect and grow your capital from an investment point of view.
Oh, that's fantastic. And as usual, thanks for stopping by, PJ. It's always fun to have you on here and to chew the fat, so to speak, and especially because you can't really go anywhere else at the moment anyway.
Correct. And I am in desperate need of a barbershop to be open. So let's hope that at some point they let some of these service providers reopen and get back to doing what they do best.
Mate, I can introduce you to my barber.
Yeah,
he does a good job.
It's a straight razor, is it?
All right, mate. Thank you very much, and we'll see you again on the next show. And mate, thank you for all your tips and your wonderful advice and wisdom again today.
No worries. Good to be back. See you next time.
All right. And look, that's it from us today. Thanks for PJ for joining us. And if you're listening on the podcast, don't forget you can look at our back episodes. Just scroll back through your podcast app and grab them there. Or anywhere we see it's broadcasting now, you can comment or share or do whatever you need to do and save. And join us every week for our next show. So next show will be next Wednesday. We've got a pretty good guest up there. You'll see that. Earlier next week, we got our goodbyes. So thanks, Steve. Thanks, Daniel. Thanks, Michael Paris and Michael Carr. Michael Carr misses us. That's fantastic. Isn't that nice? It's very emotional, our Michael Carr. All right. That's it for today. I am going to go and double check my hair because PJ's giving me a complex about it right now. And we'll see you next week. This has been Xenium Live. We talk all things money, finance, and property. And I've been your host, Scotty North, and I'll see you next time.